I'm Cornell Clayton. I'm the director of the Thomas S. Foley Institute at Washington State University. And on behalf of the Institute and our co-host today, the Institute of Taxation Research and Policy in the Carson College of Business, I want to welcome you to the event, which features Pulitzer Prize-winning journalist and best-selling author David Cay Johnston. Since 2013, the Hoops and Foley Institutes have collaborated to bring the WSU community a large number of high-quality events exploring the nexus of politics and tax policy. These have included events that look at the offshoring of profits, various carbon tax proposals, and aspects of federal tax reform, including a previous event with today's guest. David Cay Johnston is currently finishing a book on tax reform, which will form the basis of his talk today. And here to introduce Mr. Johnston is the director of the Hoops Institute, Jeff Gramlich. Jeff is a professor of accounting and the holder of the Howard and Phyllis Hoops Endowed Chair at WSU. Widely published, his many areas of research include tax-motivated earnings management, effects of different forms of corporate governance, the impact of corruption on measures of social quality and income shifting, and on controlling cash economy-based tax fraud. Jeff, thanks again for all your efforts to put together today's event, and I'll turn the time over to you now to introduce our guest.
Thank you so much, Cornell. I've very much appreciated our team effort here. David Cay Johnston won a 2001 Pulitzer Prize for what the judges called his exquisite command of complicated tax laws and of how corporations and individuals twist them to their advantage. His reporting prompted Presidents Bill Clinton and George W. Bush to change their tax policies and resulted in changes in many laws and regulations. While a reporter for the New York Times, Johnston wrote the bestsellers Perfectly Legal and Free Lunch, exposed what were then little-known aspects of American taxes. He later was a columnist for Tax Notes magazine and Reuters, and is a frequent guest on CNN and MSNBC. Johnston is a former president of Investigative Reporters and Editors, IRE, and has lectured on journalism, tax policy, and other issues on every continent except Antarctica. Johnston is also the editor-in-chief of DCReport.org, a free nonprofit news service run by former senior journalists at the New York Times, the Los Angeles Times, and Wall Street Journal. Please welcome David Cay Johnston.
Well, Jeff, thank you very much for that introduction. And the audience should know that I first learned about Jeff roughly 25 years ago because of a brilliant piece that he and another professor wrote about a huge tax dodge involving Chevron oil. Really smart piece of journalism. So I'm going to talk to you today about the tax system we have and the tax system that we could have, and how the system we could have would make us a wealthier country, would make for more jobs, and has enormous benefits. I've tried to make this as straightforward as possible for people who are not tax wonks. And when my book comes out about this, it will be a short book because it makes no sense to write a long book stopper, a door stopper of a book when you're proposing a simpler, fair tax system. So I want to share with you my PowerPoint, and we'll go through this, and then we're going to take questions. I assume that in the chat, there's a discussion about the questions that Jeff and Cornell will ask. So I am proposing a simple, fair, effective, and efficient tax system for the 21st century economy. This is a tax system that would not have been possible but for the digital age. America has a tax system created in 1915, actually in steps from 1915 to 1924, when this was the #1 selling car in America. Today we have this kind of car, and pretty soon we'll have self-driving cars, but our tax system is still a Model T. The prosperity tax means no income tax returns anymore. No corporate income tax, which I'll explain. I don't just repeal it, that would be a disaster. I repeal and replace it. And all economic gains will be taxed. John Fox, a leading tax authority who worked in Washington, estimates that only about half of economic gains in America are actually taxed. Now, I say asterisk because there's a basic exemption. People would not be taxed on the minimum level of income needed to not be in poverty. Adam Smith, in The Wealth of Nations, and his other and equally important book, The Theory of Moral Sentiments, both written in the 18th century, pointed out that if you tax the basic income people need to survive, to buy food and shelter and clothing, that you simply muck up the economic system. You want to tax things above that. The prosperity tax will have much more predictable revenue than we have now. It will have much lower compliance costs. They will fall away dramatically. The IRS will shrink radically, and much easier enforcement. Now, pay, which is how most of us get our money, like cars, has evolved. These are men lined up to get paid at the construction of what people call variously Boulder Dam or Hoover Dam near Las Vegas. And you'll notice here the word timekeeper. It is highly likely that my father was on the other side of that wall because he was a timekeeper on this project. You stood in line, you signed literally something called a payroll, pages of paper where your name was, the amount you were due, and you signed your name to it. And you'll notice the first line is for 1,500 people. So you stood there all day to collect your pay, and you got it in cash, dollar bills and coins. Well, pay has evolved. First of all, we got machines like this. This is a payroll check making machine. So if you walked into your bank with a check you said was from a business down the street that you said was your paycheck and it was handwritten, the banker would know, no, it's not. Paycheck should come from a machine like that. Today, we don't even deal with paper checks. We have digital banking, and the money just drops into your account electronically. This is what makes a new and better tax system a possibility. Now, the prosperity tax is not radical in any way. It uses only existing accounting and legal concepts, and it is based on classic time-tested principles that date back thousands of years. And for 8 years, by the way, at the law school and the graduate business school at Syracuse University, I taught the law of the ancient world. I still include it in my current course. The prosperity tax has conservative principles, and I mean that in the classic sense of the word conservative, meaning that we take those things that work and we protect and maintain them. The most conservative principle in Western civilization is progressive taxation. It is more than 2,500 years old. It is throughout the Old Testament. It was a foundational principle of the creation of the first European democracy in ancient Athens. In fact, I refer to the creation of democracy and the invention there of progressive taxation as the civil twins of Western civilization. And the compliance costs for this? Well, imagine for a moment you're a corporate deal maker. You're someone like Carl Icahn, who buys and sells companies for a living. Right now, you pay a fortune to highly, highly paid tax lawyers and accountants on how to game the tax system. All that would go away, and your compliance costs for the price of your deal would probably be in the neighborhood of a single basis point. That's 1/100th of 1%, a tiny, insignificant amount of money. Now, the corporate income tax is central to this because the corporate income tax creates a wedge between the rates paid by the highest paid workers, like executives and business owners who take a salary as the law requires from their business, and the lower rates for corporate profits. Currently, the top marginal rate for someone who is working, that is for labor, is 37%. The top business rate is 21%. There's another problem, double taxation. Profits are taxed at the corporate level, and then the investor has to pay tax on dividends. You can end up with 37% plus the dividend rate is 20 in most cases. So that's 20% on the after-tax dividend that you got. In addition, under the current corporate income tax, Congress does something utterly and inherently corrupt. It requires the IRS to tell big companies, not little companies, big ones. Here is exactly what we will be looking for in our next audit. Now think about that. Imagine that your grandmother or someone else you know is in a nursing home or is disabled. How would you feel if the authorities called up the nursing home and said, you got 72 hours to clean the place up and make it look good before the inspectors come? We don't allow this for pet shops. Why would we allow it for corporations? It is inherently corrupt. And finally, the IRS itself has been saying now for years that there are so many difficult to understand devices to defer, which I'll talk about in a minute, and tax shelters, many of them shams. They don't have the capacity to understand them. I have exposed numerous tax shelters. I've been called the de facto chief tax enforcement officer of the United States because of all the tax shelters shut down because of my reporting in the New York Times. Understanding them is incredibly mind-numbing exercise, and to prove in court the things that I reported as a journalist is vastly more difficult than that. My system will end that. Sorry, jumped ahead there. Not sure what happened to my, hold on just a second. While I go back into my PowerPoint here and figure out what went wrong. Okay, here we go. So under this system, corporations, when they make payments to other businesses, will not be taxable. Boeing pays Alcoa for aluminum to build a jet, not a taxable event. Boeing pays Professor Gramlich as a consultant to write a report for them, taxable to Professor Gramlich. Companies already have all the records of who they pay. They have detailed records. They know who their vendors are, so I'm not imposing any additional burden on them. And if they don't have records, they're not following good business practice. Overseas payments would require withholding tax because otherwise many of the companies in America owned by foreign owners or American companies with offshore facilities could siphon money out of the country and evade the tax system. And the IRS would retain under the prosperity tax the authority to examine records to make sure that those rules are being complied with, not to determine taxes due, but are you properly paying people and withholding taxes where it's warranted.
David, we're not
Yes.
seeing your PowerPoint anymore.
I'm sorry, hold on, I need to go back to share screen.
Thank you.
Yep. Okay, so those are the points. So can you see it now? Angie, can you see
We're just seeing like a top bar. We're not seeing the actual slide yet.
Oh, that's a problem. Hold on. PowerPoint is very important to this. Zoom, where is Zoom? There's Zoom. And let's stop share. And then now you're seeing me, and we should be able to get the PowerPoint back. Now, how about now, Angie?
Now we're there.
Okay, so these are the points I just went over. Payments to other places aren't taxable. Companies already have these records. We're not adding to their burdens under my proposal. So now I would also, because I said we would repeal and replace. Sorry. Here we go. Impose some new rules that actually were in the original American corporate income tax in 1909, rules that are designed to promote growth. And I want to stop here to point out that there's no right to a corporation. A corporation is an entity created with the permission of the state. So you as a human being have natural rights, and we articulate them in our Constitution. But a corporation is a creature, a creature created with the permission of the government. And so we can reasonably impose rules on them. So I would reimpose the 1909 rules to all companies. Currently, they apply basically only to purely domestic companies. 81% of the business assets in America are owned by about 3,000 companies, and almost all of them are international. Whereas mom and pop businesses, even billion-dollar mom and pop businesses, tend to be purely domestic. So there'd be a limit on cash and near cash, and there's an extensive public record about how you do that. It's not complicated. The rules, because of the limit on cash, would say you can't do what Apple did. Apple put $250 billion into savings accounts offshore. That money wasn't taxed, and it wasn't being used to grow the business. It was the equivalent of everybody taking their paycheck and going home and putting the money in a coffee can. The economy can't grow if money doesn't circulate. So under this new system I propose, profits mostly, except for the cash you can keep, you have to either pay them out as dividends to the owners, reinvest it in the business, or pay it to the workers. That promotes economic growth, unlike putting money in a savings account. Now, modern accounting has found what this man tried to find, and so did many others. They were called alchemists, and they believed that if they could find something called the philosopher's stone, they could turn gold into lead. Well, that's what modern accounting does. Modern accounting has figured out how to take taxable profits in the United States, convert them into expenses in which a company takes money out of its American pocket, pays it to itself in its offshore pocket in Switzerland or the Cayman Islands or Singapore, depending on the circumstances of the company, and takes a tax deduction for paying itself. Well, Michael Sedgwick never found, nor did anybody else, the mythical philosopher's stone. The accounting industry has, to the great detriment of our economy. Now, the benefits of corporate tax and repeal and replace are we end this transformation of tax from a burden to a profit center. When I first told my editors at the New York Times 20 years ago that I was certain that companies had found ways to turn the corporate income tax into a profit, they were totally disbelieving. There are many people to this day who go, how can you possibly turn a tax into a profit? Well, Enron did it, and I'm going to show you in a moment how to do it. It's actually very easy and well known in the tax world, and we did report this almost 20 years ago. Because we will eliminate the corporate income tax, there's no reason for companies to invest offshore. Why build a factory overseas where you may or may not be taxed and endure all the costs of maintaining executives overseas when you can invest right here and earn tax-free profits? So it encourages domestic capital investment. Well, how many jobs we have is closely tied to domestic capital investment. The 2017 tax cut bill actually encouraged moving capital offshore. And it rewarded companies that built factories offshore when they paid their deferred taxes by taxing them at essentially half the rate of companies that held cash offshore. So Congress has clearly signaled to business, don't invest in America, invest offshore. And it also focuses businesses on business, not on tax avoidance. We put enormous firepower, intellectual firepower, into tax avoidance instead of developing better businesses, better widgets, better management. Now, current federal tax law is really two systems, separate and unequal. One system is for workers. Workers have taxes withheld from their paychecks. Their compensation is verified. That's because you get a W-2 wage report at the end of the year, or if you're a gig or freelance worker, you get something called a 1099. The IRS knows exactly how much money you made because it's reported by the people who paid you. Business owners don't have that system. I'm, by the way, a business owner. I'm the successful founding chairman of a little hotel management company that doesn't exist anymore, but was very successful for more than a decade, plus my journalism enterprises. I self-report. There's little or no verification of the income of people who own businesses, unlike workers. There's no mandatory withholding except for salary. So, of course, many business people don't take a salary or take a minimal one. And very importantly, many opportunities for deferral. Earn today, report the money, and pay the taxes later. Well, why does deferral matter? Well, here's an old saying from a tax lawyer. A tax delayed is a tax not paid. The other famous saying is, if you come into a fortune and can delay the taxes for 30 years, it's the equivalent of not paying the tax. Every dollar of tax not paid now, but due in the future, is an interest-free loan from the government. And I don't know about you, but I want all the interest-free money I can possibly borrow. Well, that's what business does. It's a logical thing to do. If you can borrow money for 0 interest from Uncle Sam, you're going to do it if you're a smart business person. Here's how deferral works. So you defer $1 million for 10 years at 10% interest. At the end of the 10 years, you'll have $2.6 million. You pay the tax, you're left with $1.6 million. You've got to pay tax on that gain, and you'll end up with, after taxes, $1.3 million. You're better off for not paying the tax in the first place. You will more than double your money. Some companies earn profit rates as high as 35%, and it's not unusual to find companies with deferral periods of 30 years. At 30 years, an interest rate of a little over 4% will double your money. A business only earning 4% is not doing well. So you can perhaps triple, quadruple, 8-fold your money. So what happened here in deferral, and why should you care? Well, that $1 million that wasn't paid but was loaned out at 0%, Congress went right ahead and spent it. Congress then went into the bond market. It sold treasuries, and it borrowed $1 million, and it's paying interest at whatever the percent at the time is. At the moment, it's very low. It's a little over 2%. It's been as high as about 14%. And the cost of that loan? Well, you pay for it, unless you're a business owner. You're paying for it through more of your taxes going to interest payments, fewer government services, or higher taxes on the money you make than you would have to otherwise pay. By the way, you can't defer. If you're a worker, except for your limited retirement savings, you're not allowed to defer. And the retirement savings you have when you take the money out are not taxed at the lower rate for capital gains. They're taxed at wage rates. So if you're successful between now and when you retire, you'll pay a 37% rate on your gains, not the 20% you would have paid had you invested it outside of a retirement account. And you can only put a very limited amount of money in such an account. Under the prosperity tax, everybody goes on to withholding. Business owners can take money out anytime they want, but first the taxes get withheld. That ends two systems separate and unequal and puts everyone in the same position. Everybody will have to have a tax trustee who owns a business. Now, right now, every employer has a tax trustee. The only paycheck I get these days is from Syracuse University, and there is an executive at Syracuse University who is the designated trustee for withholding taxes and turning them over. And if he or she fails to do that, they are personally liable for those taxes. There have been lots of cases brought by people who did not turn over the taxes they were due. Every business owner would have to go get an independent trustee. Now, I know that sounds like I'm trying to make it more expensive to do business. No, actually, I'm not. The tax trustee, first of all, would be trained and licensed by the IRS. That way, we would know that only competent people are doing this. They would have to have a bond, that is a guarantee of payment if they fail to pay, and that bond would be relative to the size of their business. If you're representing a bunch of little Main Street stores in your town, you'd have a small bond. If your clients are a number of billionaires who run their own operations, you'd have a very big bond. But digital technology means that the tax trustee's work is automated. It's cheap. In fact, you wouldn't have to contact your trustee for money. You could simply say, go to the computer, put in, I want to withdraw this much money. The trustees' computers would say, well, on that amount of money, here's the amount of tax we're going to have to take and turn over to the government, and you get paid. It is for the trustee a lucrative, cheap to run business once it is set up, made possible by digital technology. Now, the tax trustee has some rules to ensure integrity. One of them is I call up my trustee and go, I want to get some money out of the account and I don't want to pay taxes on it. The law would require the trustee to say to me right then, one more word from you and I have to file a report, and that report is public when I file it, and everyone will know you tried to do this. Don't say another word. The trustee, if he goes ahead with this, is personally liable for the tax if he in fact allows me to cheat. Now, what about a false report by a trustee? For example, the trustee is in a dispute with me because I hired someone I know. Maybe he's involved with one of my grown children or my spouse, and we're angry at each other. A false report by a trustee is a crime, and it would result upon conviction in the lifetime loss of the office. If, however, the trustee and the client break the law and they evade the system and they're caught, both are liable. They have an opportunity to correct on the grounds it might be a mistake. And within 90 days, if they pay the money plus the 5% penalty, the case can go away, not necessarily, but can. If they don't do that, the penalties rise over time to as much as 200%, which means the government could collect 6 times the amount of money that was originally owed. Now, this isn't every aspect of this, it's an outline of it. But the point I want to get across is that the current tax code we have, which is almost 3,000 words long in the official government printing office version. And on top of that, there are tens of thousands and thousands of pages of IRS manual rules, guidance from the chief counsel at the IRS, court interpretations that have created a huge industry. Some people estimate that as many as the equivalent of 4 million jobs are tied in one way or another to our tax system. Is an enormous drag and waste of resources. It was necessary to do it the way we did it in 1915 when we adopted our third national income tax. The first 2 were connected to the Civil War. But now that we have computers, now that we have records from accounting where all the money goes, there's no reason to keep that system. And by the way, the actual core of our tax code is very brief. Why is our tax code almost 4,000 pages as printed by the US government? Because it's full of favors for people. Favors that say, oh, if you meet this rule, you don't have to pay taxes. In fact, in the 1980s, there was a provision that was proposed to go into law, and after it was exposed by my colleagues at the Philadelphia Inquirer, where I worked at the time, Congress did not enact it. And what did it say? No tax shall be owing on the estate of any individual who died on such and such a date in Tarrant County, Texas, and left an estate valued at not less than $12.5 million, whose sole surviving heir is his spouse. The reporters found this person. As it turned out, she lived between 2 of the Bass brothers, billionaires. One lived on the right of her, one lived on the left, and across the street was somebody else connected to the Bass brother billionaire's fortune. And when the reporter reached her, she said, oh, yeah, you mean that little thing my congressman's doing for me? Well, sure. Isn't that what your congressman's for? That's what's wrong with our tax code. It's full of these provisions that benefit people and can cause terrible harm. Back around 2010, there was a man angry over a section of tax law that isn't even in the tax code. It's in the Omnibus Budget Act one year. And it made it impossible for him to run his business the way he wanted. It was put in place at the request of IBM. It hurt many, many people. I wrote about it in the New York Times several times. It raised almost no money. It was supposed to raise $50 million a year, which is nothing in the American economy, which currently is $21 trillion a year. But Congress wouldn't remove it. And so this man got so angry, he went and got his private airplane and he flew it into the IRS offices in a high-rise building in Austin and killed an IRS worker who was a Vietnam War veteran. Horrible crime motivated by anger over a tax law we don't need to have. So just to review quickly, and then I want to take questions from people. Our tax code is far too complicated. Our tax code is full of provisions that favor someone else at your expense, and you are paying the cost of those favors. And those favors are bought with campaign contributions, jobs for relatives, all sorts of institutional corruption. We don't have to have all of these complex rules. And because of digital technology, we can trace the money and make sure that we collect in full the tax we're supposed to collect. And we can encourage domestic capital investment, which is what produces jobs, by eliminating the incentives to move capital offshore and build factories offshore for the primary purpose of tax avoidance. It won't help with cheap labor, but it will address when the primary purpose, and that's often the case, is tax avoidance. So, Jeff? You're on mute.
Thank you. So are there going to be 3 different taxes, one for corporations, one for small businesses, and one for employees? It's a little confusing to me.
No, under this system, there is no corporate or business tax. All business profits would flow through ultimately to either the investors in dividend payments, and they would be taxed on them, or the workers in salary, wages, and bonuses, and they would be taxed on them. But if you simply repeal the corporate income tax, it creates an incentive to do what Apple did. You just put all your profits you don't need at the moment into a savings account. That's a way for chief executive of the company to avoid problems. Let's say there's a downturn in the economy, and we will always have business cycles. The economy expands and then it contracts, and then it expands and then it contracts. In a downturn, if you have a huge cushion of cash, the chief executive's style of management is not going to be brought into question. I'm not saying you can't have a reserve of cash, but Apple had more than $250 billion of untaxed money in its offshore savings accounts. And by the way, the money was only legally in the offshore accounts. They actually brought it back to the United States in various guises. But all this game playing would go away. You would be taxed on your individual income when it's paid to you.
Mm-hmm. And how do you define excess cash?
Well, that's actually been decided by the courts. A famous decision by the United States Tax Court, which still exists, in the 1950s, produced a mathematical formula. And this is one of the things Congress can decide how to do, but I would basically assert that if you've got 6 months revenue in the bank as cash and near cash holdings, that's more than enough money. Most small businesses operate on 4 weeks cash. They're very lightly financed, and that's why the pandemic has damaged so many small businesses. People couldn't sustain it. But if you're a corporation and you've got 6 months revenues in savings in one fashion or another, whether it's literally bank deposits, treasuries, repo agreements, all sorts of complex financial instruments, and what's called cash and near cash. That certainly is more than sufficient. And if you're a sound business, you can borrow if you need to. And this just becomes a function of management of the cash by professionals. Why should I or the audience be subsidizing the cash holdings of a company? It's not our business to make sure that they soundly manage their cash. And it retards economic growth if we allow unlimited amounts of cash to be held.
The Washington State Senate this week passed a capital gains tax that imposes a 7% tax on the gains from sales of stocks, bonds, and other high-end assets like a classic car or a painting, in excess of $250,000 for individuals and couples.
Mhm.
What are your thoughts about that?
Well, because America is a federal system, unlike, say, Canada or France, where the provinces are subunits of the national government, states are co-equal under our Constitution with limited exceptions. It complicates our tax world. What Washington State is trying to do, I think pretty clearly, is to only tax the capital incomes, the investment incomes of very wealthy people. The number of people in Washington State who have more than $250,000 of capital income is minute. If we had time to take a break, I could go look it up in 3 minutes in my computer, but it's a tiny, tiny fraction of the public. One of the principles of progressive taxation, one of the principles Adam Smith articulated in the 1800s, is that you tax what have been called in the past in America surplus incomes. The corporate income tax and the individual income tax originally only applied to surplus incomes. We still have that concept. Currently, an individual in the United States on the federal level pays no tax on the first $12,000 of income. A head of household, 18,000, a married couple, 24. And that's what the state of Washington is doing here. It's saying we're going to impose an additional tax on the very wealthiest people. The wisdom of that, I don't know. I don't know enough details about it, but the principle that the greater the gain you've made because you live in America, the greater the tax you should pay so that America endures. That's not some new idea. It's not a lefty idea, as is often claimed falsely by places like the Wall Street Journal editorial page. It is the oldest surviving principle in Western civilization. It is older than the idea, a false idea if you study theology, that marriages are supposed to be between one man and one woman, not multiple wives and things like that, which you'll find in the Old Testament and the New. This is a much older idea than that. It is a profoundly conservative principle.
How do you effectively implement this prosperity tax when so much of U.S. wealth is being stored in offshore holdings already? And how do you get them to bring that home and pay it in wages and invest it in the company or pay it as dividends?
Well, on the corporate side, that's a very easy answer. Congress just has to pass a law saying you're going to do it. That's not where the problem is. In fact, when Congress gave, under the December 2017 tax law, this reduced tax rate for offshore money, they cut the tax rate by as much as 92.5%. Companies did not have to bring the money home. All they had to do was pay taxes on it. And many of the companies just left the money offshore, and they're building factories offshore, and they're investing offshore. Congress could have said, and you will move the money to the United States and put it in American institutions here, or we'll tax you for keeping it overseas. For individuals, it's more complicated. There's massive, massive individual tax evasion at the very top. In about 2 or 3 months on IBM TV, which stands for International Business Media, I will start a television show, a worldwide television show called The Money and Power Report, investigating or tracing illicit deals. And somewhere between 40 and 50 trillion dollars is held offshore, not from the US, but from all countries, by people who've hidden their wealth. And to give you an idea of the scale of this, the British Virgin Islands in the Caribbean are a tax haven for many people. They have the world's largest aluminum storage, according to the official world trade records. You know, storing aluminum is typically stored in ingots, bars of aluminum. If all that aluminum was in the British Virgin Islands, instead of being tropical paradises where you want to go and have a nice time on vacation, they would be shiny metal mountains 3 miles high. So it will require some transition work to go after individuals but we also have the means to go do that. But even if we assume that all that money already illegally hidden stays hidden, and of course, not all of it's from the US, and we're concerned with the US money, not the money hidden from Iran or China or Russia or Britain. It would still have an enormous positive impact to end this system and end the incentives for this system. People respond to incentives, and our Congress has created incentives that say, move your money offshore.
Okay. So this one comes from our Associate Dean, Debbie Compo, from the Carson College of Business. She says, I got a bit lost in the discussion of the tax trustee, so I'm struggling to understand how this would work for an individual wage earner. It sounded like the tax trustee was effectively my banker and held all my earnings until I withdrew them to spend. Is that correct?
No, and I'm sorry I was unclear about that. Individual workers already have a tax trustee. My tax trustee is somebody, I don't know who it is, at Syracuse University. They withhold taxes from my paycheck. This doesn't, if the tax trustee proposal I have has nothing to do with individual workers. Now, David Cay Johnston, author, who has a business giving lectures, writing magazine articles, and writing books, I currently just reach into my bank account when I want money and take it. With the tax trustee system, when I get paid by Simon & Schuster or a magazine, the money would go through the trustee to my bank account, so the trustee knows about it. They would be notified about it. And if I want money out of that account, instead of just going as I do now to my computer and withdrawing money or taking my ATM and going to the bank, the trustee software would say, well, on $1,000 that you want to withdraw, the tax you're going to have to pay is X. And that amount of money would be turned over and paid to the IRS and to the state, actually to the Treasury, not the IRS, and to the state. This only affects business owners and businesses. By the way, we have 22 million people who are sole proprietors or small business owners. A lot of these are micro businesses. Some of them are huge businesses, but those people would have to have this trustee. And because it's an automated system, think about Vanguard and what it's done to the mutual fund industry. I pay Vanguard between a penny and 20 cents on all the money in my retirement accounts and my investment accounts there. Insignificant amount of money. My average blended cost is about 6 cents per $100. That's the kind of cost you would have here. Be very, very minimal because it's automated, but it would only apply to businesses. So the dean, in getting your salary, don't worry, it doesn't affect you. You already have a tax trustee. It might be interesting to find out who at Washington State University is the tax trustee.
Okay. Here's one that might interest you. Have you had the opportunity to review former President Trump's publicly available tax documents? If so, did he utilize any of the tax provisions you discussed today?
Well, 4 years ago, as you know, Jeff, I'm the person who got in the mailbox here at my house in Rochester, New York, the front 2 pages of Donald's 2005 tax return. For people who don't know this, I've covered Donald longer than any other journalist, almost a third of a century, written 3 books that are 1 partially about him and 2 completely about him. 2 of them were bestsellers. 1 of them won an award for Political Biography of the Year. The tax documents that the New York Times has, my former newspaper, I have not seen. And they don't have the actual tax returns. In the news, you need to listen carefully. There's an important but subtle distinction between tax documents, i.e. the tax return itself, and tax information. When you send your tax return to the state or to the IRS, they lift certain data off of it and put it in a computer. They then store and put away until eventually they go and have it pulped, and they're literally made into toilet paper, your physical tax return. But what the New York Times has is what's called tax information. And I'm sure it's absolutely reliable. And I have said for a long time, Donald Trump has been tried twice already for tax fraud, which very few people know. It was a story I broke 4 years ago. It's in my book, The Making of Donald Trump. He lost both cases. They were civil, not criminal. His own tax lawyer testified against him and said that he had forged his signature on the tax return. So I think that when we get to see Donald Trump's tax records, we're going to find out he has lots of problems. But that's totally separate from the issue I want to talk about today, which is how do we get a better tax system? There will always be people who will cheat. That's why I've tried to make it hard to cheat, easy to detect, and serious penalties. And by the way, one thing I didn't mention about my plan is currently tax fraud, criminal, not civil, but criminal, requires a proving of mens rea. That is, you intended to cheat. A common defense of people, the actor Wesley Snipes used this defense, was, I didn't realize I was cheating. The tax code's so complicated. I mean, I just got the rules wrong. In his case, he wrote a 600-page manifesto that the tax system is wrong and criminal, and that was a silly defense, but the jury bought it. Under my proposal, the way the rules are set up, it is what's called a per se crime. If you're caught once violating the law, it's a minor matter. Do it 3 times in a year or 10 times over your lifetime, it's a felony, and the government doesn't have to prove your intent. They only have to prove what you did. Okay. Probably would be, if we can get Congress to do this, going from mens rea to per se would probably be the toughest thing to pass, but it would be really beneficial to stopping tax fraud.
Right. How will the prosperity system treat estates?
Very good question. In America today, we have an estate tax that applies to a shrinking number of people. An individual can leave $11 million plus change, and it's automatically adjusted every year for inflation, unlike lots of things that benefit middle class and working class people that are not. So a married couple doing no tax planning at all can leave $22 million, almost $23 million with no estate tax. The fundamental problem with it is that it is an inelegant tax because the estate tax applies to not your net worth, it applies to your net worth. It doesn't exclude something called basis. So I bought some stock yesterday from a company that's not yet gone public, as one of the insiders in it. The money I paid for the stock, I've already paid taxes on. So let's assume that I put in $1 and I get lucky, the company succeeds. It more likely will fail, but it succeeds, and I get $1,000. I sell for $1,000. I owe tax on $999 when I sell, not on the $1 of basis, but the $999 of gain. I believe we should replace the estate tax with capital gains at death. Our capital gains tax is a tax on your transferring money from one place to another. Many people who have a stock that has gone way up in value, who probably should sell it. Economic and investment theory says that's topped out, you should sell it. Don't do so to avoid the tax. And so as a result, they may lose money. But in addition, if you're over that $23 million threshold for a company, the entire $1,000 would be taxable, not the $999 gain. Now, to be clear, most estates represent gain. Bill Gates started his company with a loan from his parents. So his basis in his stock is 0. It's all gain. But there are people, a woman I wrote about in Oregon, who there were a series of deaths in the family, and there was state money that was taxed when the limit was only about $600,000, 3 times in 2 years. There were 3 sets of estate taxes applied before it got to her. She still wanted to keep the estate tax. So if we only apply the estate tax to gains, and we do it at death, which is what Canada and many other countries do, it becomes a much simpler system. By the way, under my system, one of the things I didn't go into is You will have your investments in a trusteed account, just like your 401k or your IRA is. And if you want to sell Apple and buy Con Edison, you'll pay no tax as long as the money stays in the account. I want people to be able to move their money around as efficiently as possible. When you withdraw, you pay tax. When you die, all of your accumulated gains are taxed. If you are married, your spouse can have your account separately. They don't move it over to their own, and their own account. When your spouse dies, your box and her box, in my case, become taxable. What happens if I die, my wife marries another man? Well, upon her death, my box is taxable in full, but hers can be held now by her next husband. But when he dies, the tax will be owed on that. And the purpose here is to not take away and discourage wealth accumulation. We want people to build wealth. Very few people have wealth. We need to expand and increase that. Hammurabi's Code, which is one of the things I teach in my ancient law courses and even my course now, it's 4,000 years old, has numerous provisions about inherited money and making sure that even 4,000 years ago, you were able to hold on to wealth. And we want to encourage that, but we also want you to pay the taxes on your gains, and getting to hold off paying tax on your investment gains until you die. That's a really good deal, or until you withdraw the money to spend it.
Okay. How will your prosperity tax treat cryptocurrencies?
Well, cryptocurrencies pose a problem because by design, they are intended to facilitate criminality. Their purpose is to be untraceable. And I think that's a separate problem from tax problems. We can solve the cryptocurrency problem by eliminating the secrecy aspect to it. Blockchain technology doesn't prevent having disclosure where the government knows what money you have and what you've made. And of course, when you convert your cryptocurrency into cash, there's a transaction, which we do have a record. And the cash you're going to get is going to have to go into the trustee account. So at least we would get a payout then. But I think cryptocurrencies pose a very serious problem to the world. And I think one of the reasons I'm starting this TV show, which is probably going to end up being a nonprofit public service venture, because I can't imagine who wants to advertise on it. I hope I'm wrong. There is so much illicit money flowing around the world that it is corrupting governments all over the world. It is leading to all sorts of really serious problems that threaten humanity. And it gets relatively little attention. And it's complex, it's dark, and it comes with a lot of litigation risks to report on it. But we are seeing organized crime on a scale we've never seen before. We have an entire government in Moscow that is essentially a criminal gang financed with the stolen wealth of the people of the old Soviet Empire, who in the Soviet Union, presumably the people ultimately owned the assets, but they ended up in the handful of a small group of people we call the oligarchs. And they have been involved in, I just have piles and piles of documentation on the stuff they've done all over the world, and it's horrible.
From Cornell Clayton, director of the Foley Institute, can you discuss the politics of trying to get this kind of reform through Congress?
Yeah, that's the biggest question that I get. And people ask me, well, which members of Congress have you gone to about this? I don't intend to go to any of them. Real reform in America only occurs when it comes from the bottom up. Long before the women's conference at Seneca Falls in 1848, about an hour's drive from where I live, there were women seeking suffrage. It took a long time, but they got it. Men voted to give women the right to vote. We got the 19th Amendment. Child labor laws were opposed by all sorts of people. We got child labor laws. First try was held unconstitutional, so we got a second one more than 100 years ago. We will get tax reform when there's a popular demand for it. If members of Congress suddenly realize, boy, I better be on this or I'm going to be voted out, somebody is going to come along, that's when we'll get tax reform. And I know that people hate to think about tax. Thinking about tax, many people compare to thinking about death. Tax has been made the most vile three-letter word in America, but tax is what makes our freedom possible. There is no United States of America. And here's a point I hope particularly the students all take home. We live in the Second American Republic. The First American Republic, the Articles of Confederation government, failed because it had no power to tax and no power to regulate business, which is a kind of tax. It failed. It was government by bake sale, and that doesn't work. A government is its taxes. In 1793, the founder of the modern conservative movement, the British jurist and philosopher, and of course his name just went out of my head, Edmund Burke, wrote, "The revenue of the state is the state." The specific reason that we dumped the Articles of Confederation and adopted the Constitution, the very specific reason was taxes. Article 1, Section 8, Clause 1 of our Constitution, the powers we grant to Congress. The first power, the Congress shall have the power to lay and collect taxes, duties, and imposts. That is what the United States of America is. It is a country founded to tax itself.
David, from YouTube, would a diffuse system of trustees render clients more vulnerable to theft through hacking?
Another very good question that I would say that the rules that are set up for this and the skill of the business people would matter, but the trustee doesn't have to actually touch the money. Let me cite Vanguard as an example. Vanguard is organized so that Vanguard does not hold any of the billions and I think $1 trillion now of investments that they have. They're all held in another account. Vanguard is a trustee for you. Do we have problems with banks stealing from their customers? Not that I'm aware of. That'd be a great scandal to write about, but I don't know any of those. I know banks making bad loans and banks being looted by their executives, but not by taking from customers' accounts, by doing it in other ways.
Do you foresee banks stepping into that role?
Sure. I think depending on how Congress wants to set the rules, banks could do that. Not allowing banks to do it has one very virtuous effect. It encourages other entrepreneurial type businesses. Unfortunately, we've had a long-term trend in the United States of two things that matter a lot. One is toward monopolies. That was the subject of my book, The Fine Print, The Rise of Monopolies. There are a lot of books now on monopolies, but I was pretty much alone when the book came out 9 years ago. And less competition. The too big to fail banks, as they were called 12 years ago, are now vastly bigger and have much more of the total share of banking than they used to have. And secondly, barriers to going into business. We keep putting up barriers that make it more difficult to go into business. We shouldn't be doing that. We want to encourage people to start and run businesses of various kinds. And this kind of business requires you got to be trained, you got to be licensed by the IRS, which means you're going to have to pass some kind of examination. You're going to have to be bonded, which means you better have good character and good credit and a reputation for behaving well. I'm not worried about the trustees stealing your money, particularly because we can set up a system where all the trustee can do is tap your account to take out the taxes.
Okay. So from Wazoo tax professor Richard Toulson, how many politicians, have any politicians shown any interest in this new tax system?
I've had conversations with a couple of people, not in depth, because frankly, I don't want to taint it by it becoming identified with a party or a faction in Congress. And I recognize this may be a complete fool's errand. I mean, I have a lot of people who say you're never going to change the system. Well, I don't believe that. I'm as optimistic at 72 as I was at 17 that I can change the world. And if enough people read the book, means I will make a lot of money, most of which I will give away, by the way. But if enough people read the book and it becomes a topic of widespread conversation and people saying, yeah, why am I paying all this money for a tax professional? And why am I going through all this headache? And, you know, it's incredibly complicated and difficult to fill out tax forms. It's annoying. And we could get rid of that and we could bring in more money and we could have a system where people don't get to make a fortune and pay no taxes, or they get deferral that turns the burden of a tax into, through modern alchemy of accounting, into a profit. Nobody should make a profit off their taxes, and yet lots of people do. Then I think we can get real change. But that depends on what people want and what they care about. I mean, we got rid of slavery at a cost of about 700,000 American lives, including about 40,000 Black Americans. We got the child labor laws. Women got the right to vote. We got really good environmental laws signed by Richard Nixon, which are now being decimated, or have been the last few years. We can have change. That's the whole point of the United States of America. We are responsible for the destiny of our country, and we choose. And if you don't vote, you're choosing. If you put your head in the sand, you're choosing. We can change things. And it just really isn't that hard to do it. If people decide, boy, this is a better system, insist on elect people who will put it in place, either the people who are there now or replace them with other people. And a lot of these problems go away and we'll have a more robust economy as a result.
Okay. From, I don't know how to say this, Bado on YouTube, how would this plan spur the creation of small businesses? Taxes on small businesses, sole proprietors are crippling. Would this ease the burden on these small entrepreneurs?
Well, small businesses' principal problem is not the taxes per se. It is lack of capital. Most businesses fail because they don't have enough capital, so that when there's a shortfall, they struggle. Under my proposal, I don't propose tax rates or specific numbers, but the principle should be that we don't tax anyone on an income that's necessary to be their basic income. There is something called ALICE. I was the first national journalist to write about it. You can go on Google and look it up. It stands for Asset Limited Income Constrained Employed. That is, people who work, but they get a small paycheck and they don't have any savings. ALICE. And if you put in David Cay Johnston in quotes, ALICE and poverty, you'll pop up pieces, some of them, I don't know, 7 years ago. United Ways developed this model. The official US poverty threshold, that is to escape poverty for a family of 4, is about $26,000, $500 a week. Where I live in Rochester, New York, every 6th person in what was once the richest city in America gets by on less than half the poverty level. We have families of 4 whose income is $1,000 a month. I don't know how one person lives on that, much less 4 people. And there are lots of social pathologies because of that. Congress would set a threshold. You don't pay any tax on X amount of income. So if you're a sole proprietor, let's assume Congress says it's $25,000 for a person, $50,000 for a couple, which is what Donald Trump said he would do when he announced his candidacy. Then he cut it in half, more than half. If you don't pay taxes on your first $50,000, I don't think that's an issue. And just let me add one more element to that. One of the most complicated things in the world for small business is our healthcare system. When we started our hotel management company, pretentiously named American Family Resort Hotels, we didn't own anything, we managed other people's property. The biggest time waster I had was healthcare. It's none of my business what church or mosque or synagogue my employees do or don't go to, what car they drive, who they love, but Congress says their health status is my business. It's an enormous drain on small business financially. It makes it difficult to recruit the best people because big companies are much better positioned to do healthcare. Let me explain how much that costs us. If America had the healthcare system of France, widely regarded as the best in the world, there are lots of studies about that, or Germany, both of which have universal healthcare. No one ever goes bankrupt paying medical bills. people see doctors as fast or faster than in the United States. If we had either of those health systems, the amount of money we would save is over 6% of our economy. Now, that's a meaningless number. I mean, even you, Jeff, as an accountant, does it come to mind to you what's 6%, right? Useless number. Well, I'm going to give it meaning. All of the income taxes paid by everyone who makes less than $600,000 a year, that's 99% of us, are 6% of our economy.
Okay.
So all else being equal, and it's not, this is a statistical measure, but all else being equal, if we change to their health system, which would get it off the backs of small business, people wouldn't go bankrupt, you'd see a doctor right away. Lo and behold, everybody who makes under $600,000 a year wouldn't pay income taxes. I do think that if we did that, the figure might realistically be 100,000 for one individual, 200,000 for a couple. And that would have an enormous beneficial effect. Not so good for the people who own health insurance companies, and it would throw out of work, as my critics point out, thousands of single mothers whose jobs are processing paperwork, your medical claims. We'd have to do something to find new work for them. But there's no reason to maintain a system for paperwork jobs. And I can show many laws Congress has passed in the last 40 years whose primary purpose appears to be to create paperwork jobs that detract from the economy.
Okay. I have time for two more great questions. One of them is, can you explain why Amazon had income more than $11 billion in 2018, but paid zero in federal taxes?
Well, this goes to the point I made about deferrals. Congress literally requires corporations to keep two sets of books. Now, most people, when you hear two sets of books, you think of somebody like Al Capone, mobsters. Yeah, we got this set, we show the tax people, and then here's how we really do business. Well, that's what Congress does. They keep a set of books for investors under the rules of the SEC, and you keep a separate set of books for the IRS under the tax code, Title 26 of our federal tax code. Under those rules, companies get to deduct all sorts of things, and they get to defer into the future. So when you look at the financial statement of a company, if you're an investor, and it'll say total revenue for the year, cost of producing goods, and then it'll come to a line that will say income taxes. That's not the income taxes they paid. That is the accounting record of what they owe. They may not pay those taxes for 30, 40, 50 years, but they make a record that someday we'll have to pay it. And every dollar they don't pay that year is a zero interest loan from the government, which you and I are financing without appreciating it. So a company like Amazon is able to show, as it's putting more and more money into its assets, they're not making any money. I don't think, because of the advances in accounting and the complexity that the IRS says it cannot fathom, that there's any coin in trying to beat companies on this. I think the answer is to say, we're not going to tax you on your profits anymore. All we're going to do is say, after you have a certain amount of money saved, a generous amount of money for a rainy day, you have to either pay it out in dividends, pay it to your workers, or reinvest it in the business. And that will foster economic growth. And by the way, Amazon is just one of many companies that do this, that have negative income tax rates. When I first started writing about this in the New York Times back in 1995, all sorts of people were, oh, that's not possible. Companies can't be making money off the income tax system. It's now widely known because of my work and my books. And
last question from Danny Johnston. How do you convince corporations, how we know how influential they are, citizens and Congress to pass this or work towards making our tax system more logical and productive? What are the best incentives we can offer to them?
Well, thank you. I don't know who Denny is, just to be clear, not related, the best I know. Well, that's where ordinary people come in. I mean, we've seen change happen even in modern times. The civil rights movement, incomplete as it is, brought major changes to this country because of the popular will of the people. California in 1978, I'm a son of California, passed Proposition 13. It's turned out not to be such a good idea years later, but people got it passed by popular demand in a very short period of time. So the answer to this is not to go to the top. There will be some big corporate executives who will be in favor of this. I would expect that if Bill Gates or Warren Buffett can be persuaded by somebody, it won't be me, to read my books, they will, my book when it comes out, I expect to be next year, that they will say that's a good idea because it's consistent with their public statements about the things that are troublesome in the tax code. I expect that there will be all sorts of false claims against it, as I've seen in some of my previous books, often from major organizations where it's clear from the writing the person who wrote about it didn't read the book. They just made wild assumptions. That's always a danger. But you know, it has to be the will of the people. If ordinary people read my book and they say to their friends, "You got to read this thing. You know, here, I'll give you my copy of it," or "No, I'm not going to give you my copy because I want to keep it. It's going to be an important book," hopefully. But say to people, you know, we need to be discussing this, and they go, "Why am I doing all this complex stuff when I don't need to? Why do we have a Model T tax system in the era of electric cars and on the cusp of self-driving cars?" Then we'll get reform. That's the only way we ever get real reform in America. It has to come from the people, and that is, in fact, the fundamental theory of our Constitution, that we said we don't need Mad King George or any monarch to tell us what to do. We will choose our fate.
Well, thank you so much, David. And thank you to Cornell Clayton and Richard Elgar at the Foley Institute for promoting this, making David Cay Johnston a reality for us here at Wazoo. Look forward to next time with, and I look forward to seeing you again soon, David. Take care.
Take care.